Most traders completely avoid sideways markets, and the few who do try trading them, they just get stopped out. The reason is simple. In a sideways market, price keeps giving false breakouts. Buyers get trapped at the top, sellers get trapped at the bottom, and stop losses keep getting hunted. But here's what most traders don't understand. Sideways markets are not useless. In fact, they usually appear right before a strong move, because when price stays in a tight range for long enough, it's building pressure for a breakout, and that breakout can happen in either direction. So the real question is not whether to trade sideways markets. The real question is how to read them correctly and enter at the right moment. In this video, I'll show you a Bollinger Band strategy that helps you understand when the market is compressing, when a breakout is likely coming, and how to position yourself early enough to ride the move instead of getting trapped in it. Now, why does compression happen in the first place? When a market trends, one side has clear control. Buyers are winning or sellers are winning. But during a sideways phase, neither side can push through. Buyers try to move price higher, they fail. Sellers try to move price lower, they fail. So price stays stuck in the same range. And while this happens, volatility is contracting. The trading range gets tighter. And this matters because volatility moves in cycles. After a period of low volatility, there's usually a period of high volatility. After compression comes expansion. This is where Bollinger Bands help us. Bollinger Bands are a volatility indicator with 3 lines. The middle line is a moving average. The upper and lower bands are placed 2 standard deviations away from that middle line. When volatility is high, the bands widen. They expand outward. When volatility is low, the bands tighten. They squeeze together. So Bollinger Bands give you a visual way to see what the market is doing in terms of volatility. And that's what we need to identify compression and potential expansion. Now, one thing to clarify, Bollinger Bands are not reversal signals. Just because price touches the upper band doesn't mean sell. Touching the lower band doesn't mean buy. We're not using them like support and resistance zones. We're using them to read market conditions, to spot when the market is compressing and when it's ready to expand. But not all sideways markets are the same, and that's what we need to look at next. There are 2 types of sideways markets, and they behave very differently. The first type is a tight compression sideways market. This is when the range itself is getting smaller over time. The candles are shrinking, highs and lows are getting closer together. And if you look at the Bollinger Bands, they're squeezing inward. The upper and lower bands are moving closer to the middle line. This is what traders call a Bollinger squeeze. The market is running out of space. And when one side finally takes control, the breakout tends to be sharp and clean. This is the type of sideways market we want for breakout trades. The second type is a wide-range sideways market. This is when price bounces between support and resistance, but the range is not tightening. The candles are still large. You see repeated reversals at the top and bottom. And the Bollinger Bands stay relatively wide. There's no real squeeze happening. This setup is better for range trading, not breakout trading, because there's no pressure building. The market is just oscillating. And when breakouts happen from these wide ranges, they often fail. Price breaks out, runs a little, then reverses back into the range. So the key difference is this. In tight compression, the bands are squeezing and pressure is building. That's where breakouts have real potential. In a wide-range sideways market, the bands are wide and there's no compression. Breakouts from these setups are unreliable. When you're scanning charts, you're looking for tight compression. You're looking for that Bollinger squeeze where the bands are visibly narrowing and price is coiling up. That's the setup with real breakout potential. Let me walk you through how this looks on an actual chart, from observation to execution. But before we jump into the example, let me explain the 3 key confirmations we need to take a valid breakout trade from a tight compression sideways market. First, we need a strong breakout candle that closes outside the upper or lower Bollinger Band, not just a wick touching the band. The candle body must close clearly outside. Without this strong candle close, we don't take the breakout entry, because a weak close means the breakout might be false. Second, we need volume confirmation. The breakout candle should have a noticeable volume spike. If volume is flat or decreasing during the breakout, that's a warning sign. It means there's no real participation behind the move, and the market could reverse quickly, so always check the volume before entering. Third, ideally, we want to enter on a pullback after the breakout. Now, this is not always necessary because around 80% of breakouts don't give you a pullback, they just run immediately. But when a pullback does happen, it gives you a better entry with a tighter stop loss. And that's what we're going to focus on in this example. Now, let's see how this plays out on a real chart. We're on the 1-hour time frame on a Euro-USD chart. You can use a 15-minute or 5-minute chart as well. The concept stays the same. You notice the market has been moving sideways for a while. Price has been stuck in a tight range. The candles have been getting smaller. And when you look at the Bollinger Bands, you can see they've been squeezing together. The bands are narrow, volatility has clearly contracted, and the squeeze momentum is fully formed. The market looks like it's coiling up and ready to move. This is the compression phase. Pressure is building, but the market hasn't decided which direction to go yet. So you don't enter, you just watch. Now, before we continue, let's add the volume indicator to our chart. In TradingView, you can do this by clicking on the Indicators button at the top, then search for volume and select it. The volume bars will appear at the bottom of your chart. This will help us confirm whether the breakout has real participation. Now, back to our chart. After some candles of this tight compression, you finally see a large green breakout candle. Price pushes above the upper Bollinger Band and closes outside of it. The entire candle body is above the band and the close is strong. You check the volume. You look down at the volume indicator and you see the volume bar has spiked significantly. It's much taller than the recent bars. This confirms that traders are entering and momentum is building. Now, instead of entering immediately, you wait because you want to see if the market gives you a pullback for a better entry. And that's exactly what happens. After the breakout, price continues to move up for 3 to 4 more candles. But then it starts to pull back. Price comes down and retests the middle Bollinger Band. And right at that level, a green candle forms. This is your entry signal. The pullback has held. The middle band is now acting as support. And the market is showing signs of resuming the uptrend. So you enter long on this green pullback candle. Your stop loss goes just above the middle band, or you can place it slightly above the lower band if you want more room. And for your take profit, you're targeting a minimum of 5 to 7 times your risk. Because these compression breakouts, when they work, they tend to give massive moves. The longer the compression, the bigger the expansion. After you enter, the market starts moving up again. Price pushes higher, momentum builds, and eventually your take profit gets hit. Now, I'm not saying every trade will be this clean or give you a 5 to 7 times reward. But the point is the decision-making process. You identified the compression. You waited for a strong breakout candle with volume. You didn't chase the breakout immediately. You waited for a pullback to get a better entry with a safer stop loss. And you gave the trade enough room to reach its potential. If you can do that consistently, you'll start seeing these setups more clearly. You'll stop chasing fake breakouts, and you'll start entering trades that have real follow-through potential. This video is for educational purposes only. I am not a financial advisor. All examples shown are for learning and explanation only, and the charts used in this video are from TradingView.com. Trading involves risk, and past performance does not guarantee future results. Always do your own research and practice proper risk management before making any trading decisions.